Good evening, ladies and gentlemen, and this is Barry Norman on behalf of investing.com and Trade Time for our webinar tonight on the ABCs of Japanese candlesticks. Now, tonight's class is sponsored by Trade Time. That's www.tradetime.com, one of the world's leading Forex and CFD providers. And before we get started, I'm going to tell you a little bit, or I'm going to run a video real fast to tell you a little bit about Trade Time, and then we'll get into understanding candlesticks. So that's a little bit of Trade Time, our sponsor for this evening. Uh-oh, and I just lost my class. Hold on a second. So I'm sorry about that. So Trade Time offers lots of unusual features and allows you to customize your platform. Now, they sponsored tonight's class. So let's get on talking about Japanese candlesticks. Now, if you want, while we're in class, you can go to www.tradetime.com and open a demo account and follow along with us using their charts. There's no credit card required, just a username and password, and you'll have a demo account up and running in no time. So, and you can try out their next generation trading platform. Now, tonight's class is being recorded, and you can access the recording in about 24 hours by going to www.investing.com, where you signed up for the webinar. And then use the same link you used to come to tonight's class, and you'll be able to see a recorded version. Or when you go to www.investing.com, just look for the Education tab, and then look for Webinars on Demand, and you'll see tonight's class listed in the first position once it is loaded up there. So, Trade Time is a regulated provider, so I'm therefore required to give you a risk warning. So let me read that and get it out of the way. Trading Forex, CFDs, and spread bets on margin carries a high level of risk and may not be suitable for all investors. You may lose more than your initial deposit and could be required to deposit additional funds. Please ensure you fully understand the risks and take care to manage your exposure. Now, let's get ready to start talking about this 17th century trading or charting method, because candlesticks have been around since the 17th century, and they gained in popularity just in the last few years because of online trading and online Java charts and HTML charts. Because when I started trading 40-some years ago, we had to do all of our charting by hand, and candlesticks were a time-consuming process to draw and put on your charts when you're doing everything by hand. But now, with the advancement of the charts online, everybody likes to use candlesticks. Now, each candle on a chart represents a period of time, whether it's a 1-minute time frame chart you're looking at, or a 15-minute, or 1 day, or 1 week. That one candlestick is that entire increment in time. So if you're looking at a 15-minute chart, every 15 minutes a new candle is put on the chart. If you're looking at a 1-day chart, every 1 day a candlestick is put on the chart, and that candlestick covers all the action for the day. So in other words, when we start the class, when we start using the candlestick and we draw it on there in that time frame, we would draw a line across at the opening price. At the end of, say we're looking at a 1-hour candle, at the end of 1 hour, we would draw a line across at the close. We would put a dot at the highest price it ever reached and a dot at the lowest price it ever reached. And then we would connect these dots to the open and the close lines, and then we would draw lines connecting the open and the close to form what's called the body of the candle. Now, if we step down from the open to the close, imagine it's a ladder. We step down the ladder from the open to the close, that's a bearish time frame, and we would color that in with red. If it's a bullish time frame where we stepped up the ladder, we would color that in with green. Now, these parts between the and this is called the body of the candle, And these are called the wicks or the shadows. And these show you the lowest period of the time frame and the highest. And that's what is encompassed in a candlestick. Now, too many novice traders think that seeing an abundance of red or an abundance of green is telling you to do something. But that's not the case. Candlesticks are not about the reds and the greens. They're about the size and the shape of the candle, the body of the candle, and the placement of the preceding and the next candle, and then where those candles take place in a chart. But primarily, it is about the size of the body. Now, we are all human beings, and unfortunately, as human beings, we have to deal with psychological responses. And so we naturally see red and think everything is going down, or we see green and we think everything should be going up. But that is not the case in candlesticks. Now, I have given you a whole bunch of handouts because tonight you can't learn candlesticks in a 1-hour session. In fact, I used to teach this in a 3-day session, and you still can't master them. Tonight, we can only talk about some general understandings. So I've given you a couple of handouts, one that has the top and most important candlestick patterns, one that has second level patterns, one that explains all the candles and the number of candles to you, and then the last one's what we call a cheat sheet. It shows you all the diagrams that you should be looking for. Now, the first part of a candlestick is telling you a story. And to read that candlestick, you have to understand the story it's trying to tell you. So there are 6 general diagrams that we can do, or 6 general interpretations of how the market is moving that we can see in a candle. Now, you'll see me jump tonight from black and white to red and green. Black and white are what we used to do when we hand charted. And what we do is we would just draw the lines around the candle, and in a bullish session, which is equal to the green, we just wouldn't color it in. And a black candle is equal to a red candle or a bearish time frame. So in the old days, we would just put the box around the candle, and if it was a bearish session, we just take the edge of our pencil and fill it in. So black and white, red and green are the same. So remember, white, green, black, red. So now let's talk about the story of the bulls and the bears, because that's the first thing we need to talk about when we're looking at these candles. Okay. I could tell you a story about a football game, but recently I just started telling you a story about a tug of war. Remember tug of war when you were kids? You know, you'd pull the rope, you'd have teams pulling the rope on each side. Well, so imagine there's a stream, and you're at a family picnic or a neighborhood picnic or a high school picnic or a friend's picnic, and 10 people pick up the rope on one side of the stream, and the other 10 people pick up the rope on the other side of the stream, and they're pulling back and forth, back and forth. Now, at times, the teams are pretty evenly matched. And there's other times where the guys on the left dominate the guys on the right. Now, the body of the candle, if you remember, shows you the difference between the open and the close. So if the open was here and the close was here, that tells you the guys on this side of the stream were dominated in that session. So if we had a 15-minute session and they were yanking on that candle, it means they pulled in 4 or 5 of their buddies on the other side into the water, and they've got a whole bunch of rope on their side. The opposite is true for this candle. Wide body candles. In this case, the guys on the other side of the stream dominated the play, and they pulled in the guys from this side of the stream. Now, in image number 3, we see, whether it's black or white, we see a very, very small body. Okay, what that means is there was not much movement in that period. In the market, it tells you a lot of indecisiveness. But it means the guys on the left, there's 10 of them pulling, the guys on the right, 10 of them pulling, and they got nowhere. They made no headway. They didn't move anybody. The wicks are just about equally sized. And that's telling you the bulls and the bears were kind of equal distance that trade, or denotes market indecisiveness. Number 4 is almost exactly the same, but it tells you at one point the bears, or the guys on the right side, had very big control. So in other words, the guys on the right side pulled really hard and pulled a whole bunch of guys in the stream, but then the other side was able to pull back, pull their guys out, and at the end of this, by the end of the session, they ended up just about where they started. So we see this long wick. Let's tell you. So the bears had some domination for one time, but they couldn't hold on to it, and that's why it went up and closed right where near it opened. And you can see there's no upper wick, so I mean the bulls just exhausted themselves pulling it back up. 5 is just the reverse. The bulls dominated for a second or two, but couldn't hold on to it. 6 is really the same thing, except both had their their few seconds of glory. The right-hand side tugged and a couple guys fell in. They were able to get back on the feet, and the left-hand side tugged in. But by the end of the session, they ended up where they started. And this is telling you something about the battle between the bulls and the bears. And this is important to know who was in control of the market and who was in control of that trading session. Now, once we learn to read that first piece of information from a candle, we can start reading more into these candles, because the size of the candle and the wicks tell us one thing, and then there's specific candles that tell us a more important story. So over there, it was telling us the bulls and the game between the bulls and the bears, and it's a tug of war. Now what we have are candles that tell us something specifically. The first ones that we should be aware of are called Marabuzzo. Now, can you all look at this chart and tell me what is odd about these candles? That's right, they have no wicks, no shadows, which means that the open was here in the green candle, the close was there. Now, what does that tell you when there's no wicks? That tells you the bulls controlled the market from the very open and never let go. They kept pulling and pulling and pulling and pulling those guys in until the close of that session. That's why there's no wick, because it closed at the very top of the pricing at the close. It never eked down one drop. So that tells you the bulls were very much in control, and most likely the price will continue up, not saying necessarily end up, but will bounce up at the open of the next session, because the bulls have not exhausted themselves. The red is just the opposite, where the bears were in control. So remember, this is called the Marabuzzo. When we see a Marabuzzo, it tells us something specific. You would see a bullish Marabuzzo appearing at the end of congestion or at the end of a downtrend. That's telling you that downtrend is over and an uptrend will be beginning, because the bulls have taken back control of the markets. A bearish Marabuzzo would occur during a downtrend, during an uptrend, or congestion, and that's telling you the bears have taken control of the market, and the market will most likely move into a strong downtrend. Then we come to a little confusing one, because this one looks very much like the pattern number 3, 4, or 4, 5, and 6 over there. But when we have indecisiveness in the market, and we have an open and close pretty much the same, and we have a sizable upper wick and lower wick, or equidistant upper and lower wicks, That's called a spinning top. Okay. And it indicates market indecisiveness. The bulls and the bears can't decide who's controlling the market at the moment. Okay. They're waiting for something. They're taking a breath. So neither the buyers nor the sellers could gain the upper hand, and the result was a standoff. Now, remember I told you in the beginning, it's all about where these candles are in conjunction to a trend and in relationship to the candles next to it. So after a long decline or a long black candle, a spinning top indicates weakness among the bears and a potential change or interruption to the trend. Now, the next named pattern looks similar to a spinning top, but can you see the difference? Okay. That's called a doji. A doji has virtually no difference between the open and the close. Now, it is, especially in the stock market or the commodities market, has to be virtually the same. The Forex market, it can be like the 2 to the right instead of the straight cross. The reason being is the Forex market moves in such tiny increments that the market could close a pip apart or 2 pips apart. But it needs to be that the open and the close were virtually the same. And we have, now there's several different kinds of dojis. In this case, we have an equidistant high and a low. So ideally, but not necessarily, the open and the close should be equal. While a doji with an equal open and close would be considered more robust, it is more important to capture the essence of the candlestick. Dojis convey a sense of indecisiveness or tug of war between buyers and sellers. Price moves above and below the open during the session, but closes at or near the opening. The result is a standoff. Neither the bulls nor the bears were in control. Now, when it appears next to a trend or near a trend line, it is very, very important. So the relevance of the doji depends on the preceding trend or the preceding candlesticks. After an advance or a long white candle, a doji signals the buying pressure is starting to weaken. Now, it doesn't tell you it's going to reverse, because what happens is the bulls had a very good session the session before, and they could just be taking a breather. Okay? Because you can't get buy. So the next session, they took a breather. They're trying, but it's not saying the market will definitely reverse. Just the buying pressure is eased off. The same thing in the reverse after decline. Doji indicates that the forces of supply and demand are becoming more evenly matched, and a change in the trend may be near. Doji alone is not enough to mark a reversal, and further confirmation is warranted. So if a doji appears very close to the trend line, in this case, the trend is working as a resistance line, okay, and it happens to right there, most likely it's going to bounce off of that and go back in the opposite direction. Now, it doesn't mean the trend is ending, because you have medium-term trends and longer-term trends. So here we had, you could say this was an uptrend, but it's part of a longer downtrend. So we see the doji appear, and so it means this leg of this uptrend is over, and it moved into the downtrend. And a good, well-developed trend is a push and an ease, a push and an ease, a push and an ease. And this will help you prepare for when the market is going to then do its retracement. Here again, we saw a push up and then ease back down. But it really depends on where it appears in the trend and what the preceding candles are. So before turning to the single and the multiple candlestick patterns, there are a few general guidelines to cover. So now that you have a basic idea of what candlesticks indicate with their bodies and wicks, let's cut our teeth on some simple and uncomplicated candlestick patterns. These are fairly common and quite likely to appear before you in a normal trading session. So knowing instantly what they mean and taking the proper trading decision immediately could make the difference between a winning and a losing trade. Now, in your handouts, you have the 32 most important patterns in candlesticks. The first 16 are the top candlestick patterns, happen often, and you need to be able to recognize these. You don't need to remember the names. You need to be able to see these when they occur in the charts. Okay, because there's all kinds of odd names and weird names for them. Okay, if you tell me, Barry, I see an inverted hammer, or Barry, I see that, you know, that sign, that candlestick that's telling me the market's going to go, go into a downtrend. That's all I care about. You need to know, okay, this candle is telling me something. You don't have to tell me it's a shooting star. You need to tell me that that candle tells you the market's moving to an uptrend because it's that funny little box with the long upper shadow. Because there's all types of ones. We have the hammer and the hanging man, because there's usually one for a way up and one for a way down. So the hammer and the hanging man are just the opposites. So this looks like a hanging man. Okay. The hammer looks the same. They're just in the opposite direction. Okay. So you have your handouts that will help you with these, because unfortunately in this short little class, there's not enough time to go over each one, and you won't remember them anyway. So use your handouts. I've given you ones that show you each of the candles, the shape, and give you an explanation as to what they mean. So a hammer would appear at the end of a downtrend, telling you that downtrend is over and it'll move in an uptrend, where a hanging man will appear at the end of an uptrend to tell you the uptrend is over. So again, it depends on which way the market is moving. Now, my favorite position, okay, it's called a Hammurabi. I use Hammurabis quite often. I find them very reliable, but I tighten the rules down on them very, very tight. And we'll talk about that as we go. Okay. A Hammurabi in Japanese means pregnant. So what it tells you is, or what you're looking for is a candle. The new candle is fully encompassed inside the body of the previous candle. Now, because it means pregnant, it means exactly that. You wouldn't see a pregnant person with a leg going out higher, or a foot going in the other direction, or arm going. Everything must be within the body of the previous candle. Now, my firm rule is the current candle, that's this candle here, must also be the opposite color of the previous candle. By defining it precisely, you may miss some of the Haramis, but when you get them and they fully fit the explanation, they are very reliable. A Harami is one of the most common candlestick patterns you'll come across. So it's important to recognize it, to understand what it means, and to understand its limitations. A Harami is a two-session reversal pattern. It's made up of two candlesticks and implies that the price is about to turn. It is an indication by a small body of the opposite color completely contained by the body of the previous session. Now, again, remember I told you I disagree and I want very firm signal. Some of the rules say it is not essential for the two candles to be of opposite color. I say, bull, it must be of opposite color. But this tends to give a more reliable signal. So remember, the whole entire, not just the body, but the arms and the legs, the everything, the wicks and the candles must all be within the body of the previous candle. Here's the body, and all this must be contained within that previous body. So I'll be blunt with you. A Harami doesn't always live up to all its hype. Okay. While it is touted as a reversal indicator, you may find yourself disappointed by its reliability. only time you're going to find yourself disappointed if you're not using the strict rules and looking for it where it appears. Okay, you must always be aware of where the price is trending. If is it an uptrend or a downtrend? Is it a bunch of congestion? Is it a weak, odd trend? Because when you see things happen and you have an uptrend, but it's a weak, odd trend and it's going up and easing down, and it's not a well-developed trend, the signals are not as dependable. So what have we learned so far? We've learned building a candlestick chart, understanding and reading the candle story, the explanation of candle shapes and sizes, formations, positions. We talked about dojis, haramis, tops and shadows, or which are the wicks and the shadows, the bulls and the bears, and we talked about the hammers and the hanging men. That's an awful lot to take in a little bit of time. But now we also need to talk about the multiple candle patterns. Now, we've talked about the ones. Now, I didn't make up this chart that you see in front of you. So somebody's named them cute. Nobody else calls them lonesome cowboys, 2 for tango, 3 for musketeers. I just call them the singles, the doubles, and the trios. Okay. So we talked about the marabuzu. We talked about spinning top, dojis, hanging men, hammermen, shooting stars. These are all the single candles by themselves that tell you a little bit about something, but because they're by themselves, they're not as reliable. Just like if you're looking at a double top, a triple top is a lot more reliable than a double top. So the next are the 2 position candles or 2 pattern candles. And these start telling something. And there we talk about bullish engulfing and bearish engulfing, bullish tweezers and bearish tweezers. So in a minute, I'm going to run you a little cute presentation on bullish and bearish engulfing. But they're all on that handout I gave you, the 16 most important shapes. Okay. So we're going to come back to the bullish and the bearish engulfing in a second. So let's jump past and let's talk about the tweezers. Tweezers are very odd. You'll notice them all the time because they're an open and a close of equal shape and size next to each other, of opposite color, with long shadows. Okay. And they look like a pair of tweezers. They would appear in a downtrend, and if that's the case, you would get one bearish candle followed by a bullish candle, and they would have equally shaped shadows looking just like a tweezer. And this is telling you that that downtrend is fully ended and is going to move into an uptrend. Uh-oh, I think I missed a chart here. Okay, maybe I got rid of the chart. And the bearish tweezers are just the opposite. They're flipped over in the opposite direction, and they appear at the end of an uptrend moving into a downtrend. So let me pop up this cute little presentation on bullish engulfing and bearish engulfing for you. Now you should better understand bullish engulfing, bearish engulfing, piercing, and dark clouds. Okay, they are important candles. They happen often. They are very reliable. And again, they are on your handouts. Now we go over to the 3 position candles, which are the most important, are the 3 white soldiers and the 3 black crows. And when these appear, they are extremely reliable, and they're saying, trade me, trade me, trade me. So the 3 white soldiers are 3 what would have been white or could be green, or in his example could be blue, but bullish candles appearing in a downtrend. When a downtrend is coming down, and then you get these 3 steps in the opposite color, so you get them in, the bullish formations, tell you that that downtrend is not only over, it's going to go into an uptrend immediately, and the bulls have taken complete control of the market. When you see the 3rd candle form, it's saying enter a trade now. Okay. 3 black crows is just the opposite. Okay. It is 3 red or bearish candles, or 3 black candles, that appear at the end of an uptrend. Okay. Now, if you also notice, if you want to firm up the rules, it's the 3 black crows or the 3 white soldiers, the 3 candles together should exceed the movement of the previous candle in the uptrend. Okay. So in other words, we see the 3 red candles on here, and these 3 steps in the opposite direction completely wiped out the last bullish candle. And there are some rules about how you can use this to put stop losses, take profits, and entry points. But when they appear, they are very, very reliable. So you can see here in the 3 white soldiers, 1, 2, 3, that they wiped out this movement of this candle, the last candle in the downtrend. And again, that's telling you the forces have taken over in the opposite direction, and we're not going to move into congestion. We're not a retracement. It is a full head-on reversal. Now, once you've got a gist of all these, once you've gone through those cheat sheets, you got them down pat, it's time to start moving into action. But many people say, wow, I'm too confused, too much going on. How do I deal with all this? Well, first of all, remember, each candle of a candlestick chart is a reflection of the market sentiment. It is not just the standard patterns, but with keen observation, you can master the art of trading by looking at charts without even remembering the names of the patterns. Because there are many ways to trade with candlesticks. The best is in combination with other indicators such as pivot points, resistance, support, and resistance. Okay. Because perfect patterns really appear. Okay. So you need to understand what they're trying to tell you when they do and have the patience to look for them. And lastly, I'm going to run you one last few-minute video. Okay, showing you how to use some of these patterns in your trading and how to incorporate. All right, ladies and gentlemen, I hope you followed along as John. He talks pretty fast, but he showed you 3 easy ways to look at prices on a chart and look at those candlesticks without using any complex interpretations. Basically, you can use your candlesticks to find a range high and low and draw a bigger candlestick over top of it and understand exactly what it's doing. Hold on one second. So these are ways that you can use candlesticks to make your trading decisions, but it's going to take you a while to start getting used to them. So what it takes is just watching the charts, looking at the charts, and getting to recognize these. Now, if you go to www.tradetime.com and use some of their education materials, watch their videos, and you can use their charts and watch and monitor. So open a demo account and just play with it for a little while. Look for the patterns to roll out. Look for them to figure out what is going on. And then you'll find out in no time at all that you don't have to master them all. If you just know some candles that you want to use or some patterns that you'd like to use or either some that you've become reliable, just use those. You don't need to trade them all. But if you notice when John was talking, he could actually tell you a whole entire story of the markets, not by looking for patterns, but just by seeing the bullish and the bearishness of each of the candles. So on that note, I'm going to say goodnight to everybody. Thank you very much for joining us and have a great week. Bye now.